what's going on in the stock market. And so, right now we have record stocks, and the Federal Reserve is expected to cut interest rates. So to go through today, we're going to recap the December 2018 webinar, the economy and the Federal Reserve, corporate fundamental backdrop, market indicators, and then finally the risk-reward setup and how to proceed going forward. Here's a slide from the December 21st, 2018 conclusions. And basically at that time we were in the midst of a 20% correction. And here was the views. The economy probably peaked this year, but is strong enough to not have a recession in the near term. That ended up being the case. Corporations' fundamentals are mixed and valuations are cheap enough that stocks have become attractive. And it just so happened that at the end of the time that was. Sentiment at that point was so negative that it can lead to upside surprises. So it wasn't going to take much as far as the economy and companies doing just slightly better to surprise us to the upside. That ended up being the case. Additionally, positioning surprise can lead to a very quick recovery in prices. Once again, that happened as we moved towards all-time highs rather quickly, in fact, much faster than most people had expected. Then I said we talked about how bottoms can come at any time and still may be lower from here. In fact, that was the case. We didn't bottom until 3 days later on December 24th, but again, very, very close to the bottom. And the view is that without a recession, the downside should be limited. So we have not had a recession in the first half of this year. So at that point, the downside, the 20% downside, was limited. We didn't see much more. In fact, we bottomed 3 days later from this webinar. And the last part, which leads us to today, is that we needed to follow these indicators closely, and it would be important to know when to change allocations and reduce risk. So that leads us to where we are today. And I'm going to start again with where the economy stands. Back in December, manufacturing was doing very, very well. It was close to since then has fallen rather dramatically and sits at 51.7. Now, the interesting thing with this is that the readings below 50 have provided false signals of recession in the past. So if you go back into the mid-1980s, in 1995, and remember this number because 1995 is going to be an important comparison to today, in the late 1990s, in early 2000s, again back in 2011, and also 2016. So we're not even at those levels. We have come off the highs. We are slowing. But again, just because we're below 50 doesn't mean that we're automatically going into recession. So let's look at non-manufacturing, because manufacturing is not as big a part of the economy as it was previously. We want to see how strong that is. So a lot of bulls have talked about the fact that the services sector and non-manufacturing is still strong. Now, it's interesting to see, again, above 60 last year. It has slowed to around 55. Now, above 50 is expansion, below 50 is contraction, similar to manufacturing. The interesting thing is that in both cases, we stayed above that 50 level until the recession actually happened. So this tends to be more of a lagging indicator than a leading indicator. And so it really isn't going to do much when people say, oh, well, the service sector is doing well. I don't know that it provides much of an indication as to what is going to happen going forward, more so than really showing a bottom and being more of a coincident indicator. Next, we'll look at leading economic indicators, and as I talked about in December, they were actually relatively strong, and they have decelerated pretty significantly since that time. Now, we are not as low as we were in, as you can see this red circle, as we were in other economic soft patches like 2016 and also in 2011, 2012. Now, the interesting thing about this is that one of the leading economic indicators is actually stock prices. So stock prices are at all-time highs, and 2016 and 2011 we were in the midst of 20% corrections. So if you added a correction in the stock market, I think this number would be much lower. Additionally, when you look at leading economic indicators a little bit differently, as opposed to year over year, you look at the percent change month over month to get a quicker read. This number is actually turned negative. Now, as you can see, because it's month over month, it's a bit more volatile. It moves up and down as opposed to a much more smoothed year-over-year indicator. But again, as I mentioned previously, stock prices are an input, and with stock prices at all-time highs, we're at a negative number. Not quite as negative as 2016 or 2011, but in both those instances, they're lower. They were lower because stock prices were lower. This number, this change, if stock prices are to sell off or start to even have a minor correction, you're going to see this number be much lower than it currently is. Another indicator, which is the Chicago Fed national activity, and that has actually reached recessionary levels. And if you look at the chart on the left, this looks at how many months in a row that the national activity has been negative. It's a smaller subset, so it looks at the last 2 cycles. And as you can see, up top here is the national activity, and with the shaded area being recession, and below is the S&P 500, and marked by the red line and also the yellow dot. So as you can see, back in 2001, the market had already peaked, and we had negative activity, and we still had a ways to go downward in the bear market. Additionally, in 2007, it was almost coincident with the peak in the stock market before it turned lower. Now, interestingly, you don't want to just take 2 pieces of information and draw a conclusion. It's better to look back at as much information as you can to try to draw a conclusion. On the right here, this is the same, basically the same chart that looks at how it has been over the course of time, going all the way back to the 1960s. Interestingly, it has been more coincident than leading, other than the last 2 instances here on the left. So if you go back to the early 1970s, it spiked up as we were in a bear market. In the mid-1970s, it spiked up as we were in a bear market, so it marked a bottom. Again, in 1980s, it was near a bottom. In the early 1990s, in the bear market and recession of the early 90s, it spiked up as we were at a bottom. It was only the last 2 where it was a little bit more of a leading indicator. And as you can see, where we sit today is much more elevated and similar to all those instances of a recession. And back here on the left, even the corrections that we've had, if you look at this bull market here, we are higher than any level we were even from 2016 or 2011. So it's something to keep an eye on. One other thing to look at is employment. And because employment is, going back to the service sector versus manufacturing, the consumer discretionary and consumer spending is a big part of the U.S. economy. And so if people have jobs, they're going to continue to spend. And employment so far has held very strong and has showed no signs of slowing. This is going to be important when we look at the Federal Reserve and interest rate cuts and how successful they can be, because if you look here in the green circle, again, I'm highlighting 1995 because that was a successful rate cut. The Fed had more room because we had 5.5 to almost 6% unemployment. So there's much more room to get it down to that 4% level. Right now we're at 3.63%. So there is very, very little room. We're basically at full employment. There's very, very little room for employment to get much better from here. Now, another thing to look at is the Conference Board labor differential. So this is a difference in labor. So it looks more at a rate of change as opposed to an absolute level. And interestingly enough, it tends to peak right before a recession. And so it did back in 1999, it did back in 1990, and it did back in 2007, and it appears like it is doing it again now. You need more data to confirm this, but again, it's just another thing to give a little bit of caution. Now we'll look at interest rate indicators, because this will help put the picture together. The yield curve, so there's a lot of different treasuries. There's 3 months, 6 month, 1 year, 2 years, 3 year, 5 year, 7 year, 10 year, 30 years. So that, if you put those all together, that makes up a yield curve. And it's important to look at this because the bond market is a lot slower than the stock market and not quite as affected, and people tend to believe that they have it's bigger money that's going in there, so it's not fast money that's trading in and out. They're taking longer term positions, so they tend to be better predictors of what is going to happen going forward. Now, there are different parts. So right here we're talking about a 3-month yield versus a 10-year yield. When it's inverted, that means you're getting paid a higher interest rate to hold a bond for 3 years than to hold one for 10 years. Again, doesn't normally make sense, but it happens from time to time. Now, as you look on the left here, this is talking about how long the 3-month and 10-year yield curve has been inverted for 30 straight days, and goes all the way back to the 1980s. It clusters around the peak in 2000 and clusters before the peak in 2007. And as you can see here, we just have, it had just gone over 30 days very, very recently. And again, as we sit today, it actually, the inversion is gone. We're actually slightly better, but again, very, very close to flat. And again, this is an expectation of the Federal Reserve cutting interest rates. So again, two very, very ominous signs when you look at the last 2 times we had more than 30 days of an inverted 10-year and 3-month yield curve. Now, if you look on the right here, it also puts this into perspective of how many days, and it puts it on a different level to see where we sit. Where we sit today is elevated. Again, not as elevated as 2007, 2000. More so than 1990. In fact, 1990 never got to, even though we had a recession, never got to 30 days, which is why it doesn't show up on the left here. The early 1980s, which was a double dip recession, 70s, early 70s, and then late 60s. So in every instance, other than this one instance here in the 60s, in almost every instance, an elevated level of inversion has led to a recession at some point or another. I will point out as well, because I don't want to sound overly bearish, if you look back to 2006, 2007, this stayed inverted for quite a long period of time, and stocks continued to move higher before the eventual drop. So we can see a similar type scenario where we are here as well. Another way to look at this is the euro-dollar curve, which is very, very similar to the 3-month and 10-year yield curve. In fact, we are inverted again where we sit now. The last 2 times it inverted very briefly was the global financial crisis and also right during the tech bust. And so one thing to look at again is, as we have corrected, there's been several corrections in this bull market since 2008. Actually, I should say since 2009. That's when the bull market started. In each one of those instances, so even 2011, we never had inversion. In 2016, we never had inversion. And here we are at an inversion, and stocks are at an all-time high, not at a 20% correction during the previous 2 instances. Now, even though the 3-month and the 10-year is inverted, the 10-year and 2-year spread has not confirmed either inversion, the euro-dollar or the 3-month or 10-year. In fact, the last 3 times we had a recession, it inverted in 2007. It inverted in 2000. It inverted in the late 1980s, early 1990s. And this red line over here shows that, in fact, we have not inverted in the 10-year, 2-year spread. So, mixed signals again. You're seeing very, very recessionary things from one, and a non-confirmation from the 10-year, 2-year spread. Now, another thing that is interesting is not only just the spread of interest rates, but how much credit risk is in the market. Credit risk is important because it shows how willing people are to lend money, and also it is a form of liquidity. So when credit dries up, liquidity drops out of the system, and you can see crashes in the stock market. In fact, we had one that's part of the reason why we had the drop down in 2018, and then also in 2016, and also in 2011. Now, what the bulls will say is that credit risk is still very, very low, and you can't argue with that. their spreads are not that wide. As you can see here, we're sitting at 3.8%. When we spiked almost to 5.5% in 2018, we were at almost 8% in 2016. We're at almost 8% in 2011. So nowhere near those lows, those high spikes in credit in the 2011-2016. But again, one thing that I will say is that it seems like the credit cycle actually did peak, because we were at almost 2% back in 2014-2015. We had a spike higher, credit spreads dropped, and we didn't quite get back down to those low record levels. We spiked and we dropped. I don't think that we're going to see this until we have a recession and the cycle works itself out. I don't think we're going to see credit spreads drop down to that 2% level again. I would expect them to continue to grind higher until we get a spike into a recession. So it's just one place where, especially with interest rates low, for investors that are relying on some type of fixed income, you need to be careful of what type of credit risk is there. Because even though you're getting higher yields, in the event of any type of downturn, you're not going to be as protected as you think. So it's important to look at that. Now we get to the Federal Reserve. So the Federal Reserve is expected to cut rates next week, and stock prices have moved higher in anticipation. Now the interesting thing is a lot of news outlets have portrayed this cut as unnecessary and politically driven. I'm not going to get into a political discussion right now, no need for that, but our view is that the rate cuts actually are warranted because the economy is slowing, and slowing rather dramatically in some instances. So the question really becomes is whether these rate cuts will stimulate the economy and provide a soft landing without a recession, or if the Federal Reserve is already too late and they're going to need to cut rates much faster in order to reduce the effects of a potential recession. Now, here is a great example of why these rate cuts are warranted. This is a chart from the New York Federal Reserve on recession probability. And so it's taking it right from the Federal Reserve. And the interesting thing is it basically puts a probability on recession in coming up. So if you look here, we're at 32.88. So there's a 33% chance of recession in 2020 because it looks a year out. And interestingly, let's just take since the last recession of 2008 that probability. So you see in 2011 it spiked higher and then dropped down, but again, not even to 10% probability. In 2016 it spiked higher, but barely to 10%. In 2018 we were at about 10% in the correction, the 20% correction. So we were only around 10%. Now we're at 33%, and we're at all-time highs in the stock market. And if you go back and draw that line, in every instance that we were above this level, spiked to this high, 2008, we had a recession. 2000, we had a recession. 1990, we had a recession. In the early 1980s, recession. Recession, recession. There was one false positive, and I talked about this in the 10-year, 3-month 10-year yield curve. There was one false positive, and we had one as well in the 60s. So it's not unprecedented for this to be a false indicator, but the data is overwhelmingly in favor of the potential for a recession. So again, we get to rate cuts and whether or not it will provide a soft landing or whether they're behind the curve. Interestingly, if you look at successful insurance cuts from the Federal Reserve, you had 1995 and 1998. Again, I'm bringing up that 1995 because that was probably the most successful. 25 basis points 95, 25 basis points to start it in 1998. In 2001 and 2007, we started with 50 basis points and 50 basis points, and it became clear very, very quickly that the Federal Reserve was already behind the curve, and they had to drop rates much, much more significantly, and we had pretty severe bear markets. So where do we sit today? I don't know if next week the 25 basis points or 50 basis points is going to be a clear signal, but I will go back to the point that in 1995 we had a successful rate cut with much higher unemployment, and also in 1998 we had a scare as well, and they both ended up blowing asset bubbles much bigger than they could be. So, speaking of bubbles and recessions, recessions are formed from excess. When excess is in the economy and that excess comes off, that is what causes recessions. Now, the economic recovery since 2008 has been long and it has been slow. And the argument has been that it has not caused any excesses in the economy. However, when you look at value versus growth stocks, there are definite signs of excesses and extremes in this case. Now let's look at this chart on the left first. So the blue part of the chart shows when value stocks are outperforming growth, and the pink area is where growth outperforms value. As you can see, value tends to outperform for longer periods of time and in much greater effect. And the growth outperforming value tends to be much more clustered and short-lived. Interestingly, the growth outperformance has been pretty dramatic during this entire bull market from 2008. So you can see, in going into 2011, going into 2016, both corrections in the stock market, we had pretty big outperformance from growth to value. Interestingly, where we sit today, we have only been this extreme in two other instances, 1999 and 1929. And these were two times where the forward returns were not very good. Now, I'm not saying that it's going to be exactly the same because every time is slightly different, but again, it just puts some concern. Additionally, when you look to the right, this chart over here, you can see that the value and growth, it is at the lowest level since 1999. So we're at exactly that same level. Very interesting, and I believe it is showing some excess in the market. Now, again, this is going to be a theme throughout this. You can't take one piece of information and draw a conclusion. So you want to look for other things that support your thesis. So one of them is that IPOs are flourishing. In fact, we saw, and this is actually as of December 2018, we have seen the highest percentage of negative earning IPOs since the dot-com era. So that means that we have IPOs that are coming to market that don't have any earnings. And if you go back to 1999, obviously it was a great time for the stock market, and there was many companies that came public that didn't have earnings, and the stock prices did absolutely fantastic. We're seeing that again. And one of the interesting things is we're seeing a lot more IPOs this year. Right? We had Uber, Lyft, Beyond Meat, CrowdStrike. There's a number of names that have come to the market, and a number more that are supposed to come to the market that again do not have positive earnings. Now, the interesting thing about this, and I think this is very important, is to understand what an IPO is for. An IPO basically is a private company, and just like when you raise equity or you raise debt, you're basically funding the operations of your company, and then it becomes public, and the stock trades. But the most important thing is when you make that IPO, there is money that comes into that company to allow them to use that cash to fund their business going forward. Now, the higher the IPO price, the more money that comes in, and the more buffer that you get. So it's very important for stocks to IPO at very good prices. Now, the flurry of IPOs, I don't think it's a coincidence that it's all happening at once, and because these companies, these corporate, the people that are running the company want to get the best price possible before things turn down. Now, the example that I'm going to use here is WeWork, and this is, I think, is unbelievable to me. But the founder is actually taking out $750 million before the IPO. So with how strong IPOs have been performing this year, why would somebody want to take that much money out of a stock when they could potentially see, with certain companies like Beyond Meat, which is up 500%, you could see that $750 million grow almost exponentially in a short amount of time. So why would they be taking this much money off the table? And additionally, they're moving up the date. They were supposed to do it at the end of the year. Now they want to do it in September. Why is there this rush? Again, just some type of concern. So now we'll look at corporate earnings and see how corporations are performing. And frankly, they're mixed. There's some good things and there's some bad things. Here's a couple examples. Caterpillar North America sales grew 11% while Asia dropped 8%. So strong domestically, poor internationally. There's a lot of mention about trade and trade deals. UPS CEO said timing couldn't be any better for adding aircraft as shipping is very, very strong. So again, consumer driven, they are global, and they are putting money to work by adding aircraft to increase capacity. That is actually a very, very strong signal. Now you look at CSX, which is a rail. They lowered guidance amidst a weak intermodal market. Intermodal is basically means it can go. It's shipping that goes from a boat to a train to a truck. It can go between all different modes of transportation. That guidance is weak. So again, that is more based on the global economy, and that is weak, and that is driven by trade. On the other side, you have Texas Instruments, which chips have been down, and they stated that we were 3 quarters into a downturn that usually lasts 4 to 5 quarters. So that is bottoming, and things are better than expected, and the stock price is reflecting that. So that looks good. Visa, everybody knows Visa. Their cross-border volumes increased 7%, and payments were up 9%. Very, very healthy. Pulte Homes, so a home builder, they're saying they see no evidence of the second half slowdown. However, they're seeing active adults slowing, so people that are housing for 55 to 75 age, and first-time home buyers increasing with it up 30%. Very, very interesting, especially when you take in account the Federal Reserve, cutting interest rates, lower mortgages, should provide a strong backdrop for housing. We haven't quite seen that yet, but that may be more indicative of the demographic than it is the interest rates. And then lastly, Ford, everybody knows cars, their profit was down 86% on a restructuring charge. Again, restructuring, that is a one-time thing, so you don't want to take that 86% at face value. But it does include cutting 7,000 workers. So again, going back to employment being strong, a cyclical sector of the economy like cars, and you're seeing some downside. So how do you put it all together? And I know this is just a small subset, but you're seeing trade causing problems, you're seeing consumer doing well, and you're seeing some weakness in homes and autos. Now, outside of looking at that, one other thing to look at is how the corporate insiders are reacting. So these are the CEOs, the CFOs, the chief operating officers that know the ins and outs of their company and have that information before they make it public to anybody else. So they have more information than anybody. And the interesting thing is that they are actually selling shares at all-time highs at the fastest pace since January 2018, which also happened to be a peak in the market. Again, not saying that this means that things are going to be terrible going forward, but it's an interesting note that corporate insiders are selling their shares while we are at all-time highs, even though other people are continuing to push prices to all-time highs. So that's a lot of information so far, but we're going to take one more look through reading the tea leaves. What I mean by this is many times different asset classes can tell you what is going on under the surface. This can be used to either confirm sustainability of upside moves or provide caution that this upside is about to turn. So the next several charts are going to be looking at prices and to see if there are any divergences or things that are not confirming upside or downside that can maybe tell us something more than the economic numbers. One thing that's important is market breadth, and that means many indices and stock market is weighted heavily towards the bigger companies. So, for instance, you can have the S&P 500, and you could have, and this is an extreme example, but you could have 495 stocks that are going down and the 5 biggest stocks going up, and the stock market can do and hold its own and actually not move down or move down very, very lightly. So there's one thing, and it sounds again very ominous, called the Hindenburg-Omen, actually tests market breadth of stocks that are hitting new highs versus new lows. And interestingly enough, and this actually goes back to 1960, you can see that there are several instances, and they tend to cluster around themselves, where this happens. And there's times where it happens and stock prices go up, and there's times where it happens and stock prices go down. But when you add it all together, the average returns are actually pretty poor when you look at the next 3 months. In fact, the win rate is only around 30%, where stocks actually move higher 30% of the time. And on average, they actually do drop a few percentage points. Again, not terrible. A couple percentage points at all-time highs is not terrible, but it does provide some caution. Now, interestingly, if you go out 1 year, the average return is positive 3%, and the win rate is positive 60%, which seems, in and of itself, seems, oh, okay, well, that seems pretty high. But when you take this in context of the historic stock market, actually, the win rate is on average 80%, and the average 1 year return is around 8%. So even out 1 year, once this indicator pops up, returns are slightly lower, actually significantly lower than average. So, and again, I've talked about this throughout the entire webinar. There's no single indicator that will be right all the time. But if you look at this Hindenburg Omen, the last 2 indicators were in September of 2018 before 20% correction, and in January 2018 before we had I think it was 12 to 15% correction. So pretty big corrections, but you had several indicators in either one of those before you had downside versus we just started to get a couple of them within the last week. So now we're going to look at divergence, and this is used to confirm moves in the stock market. So here is the S&P 500 advanced decline line, the cumulative advanced decline line, and it just shows the amount of money that's moving into stocks. So this is 2018, 2019. The yellow line is the S&P 500. The white and blue shaded area is the advanced decline move. As you can see here, we never hit a new high in after the first downturn in October, and then we moved to new lows in stocks at the end of last year. Interestingly, though, the reason why I have this line marked green is after this correction in late January, the advanced decline line actually broke out and moved to new highs well before we recovered new highs in the stock market. We were still at around, near 2,600, almost 2,650 when the advanced decline line moved higher. And as you can see, stocks moved higher. We had the downturn in May, and in early June, the breadth moved to new highs before the stock market moved to new highs. So, and we are currently sitting at new highs. So this is actually a very strong indicator for the S&P 500. Interestingly, if we take this same analysis and go back to the last bear market in 2007, you can see here, again, the white line is, the white and blue shade is the advanced decline, and the yellow is the S&P 500. We peaked in May of 2007 on the advanced decline line. We did not hit a new high. Stocks dropped. We saw that can happen. Advanced decline line moves lower. The stock prices went to new highs, and the advanced decline line did not hit a new high. So the price led the advanced decline line, and it ended up being a false breakout. And then, as you can see, going, and the advanced decline line hit a series of lower highs as we moved into a bear market. So for the S&P 500, we have not seen a divergence yet, but it will be something to look at. Interestingly, as you look at the NASDAQ, which is filled with technology companies, and has performed about 27% this year versus the S&P at about 22%. If you look under the surface, the NASDAQ is actually weakening, unlike the S&P 500. So the stronger index is actually weakening underneath. Something interesting to look at. So white line being advanced decline, yellow line being price. So we peaked back in the summer of 2018, moved lower, and as we set a new price high in April, lower high. We had a correction, we moved to a new price high again, and a lower advanced decline line. That is a negative divergence and something worth looking at. And it was interesting because if you look at the headlines and you hear about the big companies like Microsoft, Amazon, Google, Facebook, Apple, they talk about how strong these companies have been and how they've been a big driver of this market. And for many years, they have been. So when you actually take a look at these stocks individually, only one of those leaders actually has confirmed a new high, and that's Microsoft. So you can see here, we had the correction in earlier this year. It went to a new high and has continued to move to new highs over the course of the year. Very, very strong for Microsoft. Now, as you look at Amazon and Facebook, they're actually only testing those highs right now. So even though the market is at new highs, some of these market leaders are only testing those new highs. We're right at that now, and Facebook is right at that level now. Interestingly, with Facebook, if you go back to the summer, actually almost exactly a year ago today, dropped 25% in one day, and we still have not recovered, even though the stock market has hit new highs. So again, not terrible, because both of these stocks can break out to new highs, but somewhat concerning that the market has hit new highs while two of its leaders have not. And next you look at Google and Apple, which are a little bit more concerning, where Google had in April had gone to a new high right before its earnings. So we had a false breakout, earnings surprise, stock has moved lower, and we have not come anywhere near it since. Additionally, with Apple, it peaked in September of last year. We had the recovery earlier this year, did not hit a new high, and we are also getting, with the another new record in the NASDAQ recently, we have not even breached the high that we saw in April. What's going forward, but it shows the underlying weakness in some of the big leaders of the NASDAQ. So even though the NASDAQ has been the best performer, some of its big heavyweights are showing some weakness under the surface. So the other thing that we can do is you listen to price action. And what that means is, so we did that a little bit with the NASDAQ leaders. Now we're going to look at how economically sensitive commodities industries and indices can give us clues as to the economic and market expectations. So this chart below here actually shows small caps. They are hitting, the red line shows that they are hitting lower highs, similar to Apple, but not yet lower lows. So here's the green line. So you can see, it tested this several times, moved to new highs. It broke below it slightly quickly, and then recovered rather quickly in 2018. And we touched it again just recently and bounced off that. Now, the reason why this is important is it tells us right now that, one, it's not confirming the new highs in the S&P 500 or the NASDAQ, because the small companies are doing more poorly. But at the same time, it's also not breaking down. So it kind of puts us, well, we need a little bit more information to get confirmation. So two ways to look at it. We start to break these levels and move higher, would say that, okay, the Federal Reserve has done its job and the economy is about to reaccelerate, or vice versa, if it breaks below this line, saying, you know what, the Federal Reserve is going to have to cut interest rates a lot more and things are going to get worse. So one thing to provide caution now, but you're not going to make an absolute move yet. Other areas, banks and transports, again, very, very tied to the economy. Transports on the left here, we had a high in 2018, a lower high, lower high. very similar, but we have also not broken down yet. Banks, similar. And this one's a little bit more ominous because I'm not going to get into all technical indicators, but you can see you're getting a shoulder, a head, a shoulder with a neckline. This is a very, very good indicator of a reversal in trend. So if it were to break this neckline and move to the downside, that would be pretty ominous. Vice versa, if it were to break to new highs, that would be a good indicator that the economy is going to recover. Next, you want to look at commodities that are very sensitive to the economy. So we have oil and copper. Oil, again, hit a high in 2018, a lower high and a lower high, and copper had a double top between 2017 and 18. We had a high earlier this year in expectation of an economic recovery, and interestingly enough, we are sitting at the lows, not very far off the lows of 2018, which a break lower could be very, very bad, and a break higher would be good. In any case, most of these economically sensitive areas are showing that there is weakness underneath the stock market, which is, again, why the Federal Reserve is about to cut interest rates, because there is a lot of weakness. Now, I don't want to sound overly bearish because there are parts of the market that are economically sensitive that are doing very, very well. And I will use semiconductors as an example. So you go back to Texas Instruments, which I talked about, that basically said that things are bottoming. And interestingly, they peaked in 2018, and now they hit a new high earlier, dropped down in May, and again, we are hitting new highs. This is an area, and especially when you're thinking about the trade negotiations with China, that is very, very sensitive to this. And so maybe they're predicting that a trade deal does get done, while the other areas of the market are saying, yeah, a trade deal might get done, but it's not going to affect the economy. In most cases, you're not going to know till after the fact, but it's interesting to notice that, you know, one of the areas is showing strength in this market. So how do we put this all together? One thing is that you should never draw a conclusion from one piece of data or chart, because you can almost always find something on the flip side. Right now, the sum of all the information, so the economy, insiders, the Federal Reserve, the underlying companies, market breadth, it is leaning more bearish at a time when stocks are at all-time highs. Will be impossible to know which one of these. There's a lot of different indicators, and there's more that I haven't even put into this webinar. It'll be impossible to know which one is actually telling the truth until after the fact. Now, I will say that the Federal Reserve interest rate cuts, they can be enough to stabilize this economy. But given where the unemployment rate is, they will probably have to cut interest rates a lot more than once or twice in order to have a real impact on the economy. And then additionally, trade negotiation and tariffs are probably the biggest wild card in the entire situation. And they could, if we get a trade deal and tariffs are reduced and we have a good trade deal with China, and that can remove a big overhang of this economy and the stock market, and that can provide the impetus for another leg higher in stocks, and that is not out of the realm of possibilities. So what's the course of action? So when you combine all of this together, the risk reward is skewed to the downside. I'm not saying that we're 100% to the downside, or that we can't have the positive effects from the Federal Reserve or trade, but we are recommending, given the amount of negativity that has come out through the first half of this year, to start scaling back risk across the different portfolios. So whether you're in fixed income, take credit risk down. If you're in stocks, make sure that you can still make money in them, but start to scale back the risk. In fact, we plan to continue reducing risk into market strength. So there is still the possibility that we see upside from interest rate cuts. Should we see them, we will be scaling back risk a little bit more. Should we get upside in a trade deal, we will be scaling back risk a little bit more. Additionally, in the event that these indicators start to deteriorate more rapidly, we would be looking to reduce risk even more rapidly as well. Now, I will caveat this by saying it is not necessary to eliminate all risk, because the Fed has the possibility of engineering a soft landing, and a trade deal with China can remove the economic roadblocks. Those things can happen. So you do still want to have some risk, because you don't want to be holding nothing if the stock market is going to rip higher another 10 to 20%. The thing to do, so even though you want to reduce risk across the board now, with what's left in your portfolio, employing a risk management strategies is very, very important. So what you can do is you can put stop losses. So if you have a stock trading at 100, you put a stop loss at, let's say, 95 or 90. So if the stock drops below that level, you're out. You move out of that stock and you sell. You keep your gains, and so it protects you from that stock dropping from 100 to 95 to 90 to 80 to 70 to 60 to 50 and having it continue to move lower. Doesn't mean you can't drop and go to 90, you get out of the stock and it moves back to 105. That happens. Don't beat yourself up. It's just a risk management to protect yourself from the much more significant downside. Other things you can do is buy protective puts. These are put options. You buy them as insurance against your portfolio, and also you can sell covered calls, which is basically you get premium for the stock should the price move a little bit higher. In other words, you have no problem losing your stock. Say you have a stock at 100, you sell a call at 105. Somebody pays you $1 for that. You keep that $1. The stock goes to 106. You sell that stock at 105. Nothing wrong with putting these risk management strategies, a combination of them, in place to protect yourself should the worst happen and we get ourselves into a recession. So that's all I have for today. I hope I got through it relatively quickly and didn't put anybody to sleep. But the bottom line is, if you have any questions or follow-up, please feel free to reach out and contact me. And additionally, the things are not absolutely terrible, but there are enough warning signs on the horizon to start scaling back the risk of a portfolio. Thank you, and I hope everybody has a wonderful day.